So with that, I want to welcome Alex Morsing from Equivesto. How you doing, Alex?
I'm doing great, Craig. Thanks for having me. It's good to be here.
Yeah, and it's I saw the sun shining out there. We had a gusty windstorm this weekend, and now it looks like the good weather might be back for a bit.
Yeah, it's you never know what to expect with Canadian weather. It's always a fun time.
Yeah, if you don't like talking about the weather, then Canada's probably not the right place to be.
Yeah,
Now over to you, Alex.
perfect. Thanks, Craig. So today we're talking about how to become a startup investor. And just to frame this a little bit, I'll be talking about becoming a startup investor specifically in Canada, and how regular individuals can become a startup investor. These are the different topics that we're going to cover. When we look at investing in startups, traditionally it was something that was restricted really to high net worth individuals. So the rules in place before 2016 in Canada essentially limited investment in startups to individuals who were called accredited investors. They're also called angel investors, and they do angel investing. And with accredited investors, usually the minimum investment in a startup is $25,000 or more. And to become an accredited investor, you have to prove at the time of making your investment that you have over $1 million in net worth, excluding your house, or you're making over $200,000 a year. And so most individuals don't actually fall in this category. You could have also invested before if you were a direct friend or family member of the founder of the company, but this is usually a very small group. So there's not many people who happen to directly be related to whichever company that you might want to invest in. So before 2016, those were really the only two options. And if you wanted to get into startup investing and you didn't fit into those categories, you were pretty much out of luck. You had to essentially try to back things through Kickstarter or other ways, but you would never receive returns for those. That would always be as a donation or the purchase of a product. So with the launch of equity crowdfunding in Canada, it's finally possible for regular people like you and me to finally be able to invest in startups in a legal, safe way. So, with equity crowdfunding, essentially, we use digital technology to allow many individuals to invest smaller amounts, and then we pool all that using technology and make one larger investment in a business. To participate in equity crowdfunding, it's quite open. So you need to reside in a province that allows equity crowdfunding. So in Canada, not every province allows their residents to participate in equity crowdfunding. You need to be 18 years or older. And the minimum investment is $100. So you need to at least have $100 that you'd like to invest. But other than that, there aren't really any restrictions on your ability to participate. So it's really open for everyone. And given that this is the easiest way to participate, the discussion today is really going to be about equity crowdfunding and how you can become an equity crowdfunding investor, specifically with my platform, Equivesto. So, to go a bit more into detail about who can actually sign up as an investor on the Equivesto portal and invest in equity crowdfunding. So, our focus is all about inclusivity. You need to be 18 years or older, as I mentioned, and the provinces that we operate in are currently Ontario, Alberta, British Columbia, and Nova Scotia. We currently do not operate in Quebec, even though Quebec does allow equity crowdfunding, and there are platforms that allow equity crowdfunding in Quebec. So I would recommend looking at one of those, or waiting until we onboard Quebec, which hopefully will be sometime next year. And you need to have at least $100, which is the minimum investment on the Equivesto platform. Each equity crowdfunding portal can set their own minimum investments. And as well, the company seeking investment can also set a minimum investment. So while Equivesto's minimum is the $100, there are other platforms with a $500 or $1,000 minimum investment, and individual companies on the platforms may set their own higher investment minimums. So you're going to sign up and you want to get started with creating an account. It's quite simple. You go to our sign up page, give your email, create a password, and that's sort of the first step to creating an account. But there are a few more steps between that and investing in a business. And we do need to collect some personal information from you as the investor. And many people wonder, why do we have to collect this information? If you're signing up on Kickstarter, there's much less information that they need to collect. And the real difference there is with Kickstarter, you're essentially purchasing a product in advance, or with GoFundMe or Indiegogo, you're donating to a cause. And so in that scenario, because the money and the value is essentially traveling one way, you are giving your money to this company. There's not as much information that needs to be collected. However, with equity crowdfunding, because you are actually purchasing ownership of a business, and they're giving you those shares in return, we do need to collect some more information to confirm your identity, because we have to make sure you're legally allowed to be investing, and know exactly who is investing in the business, as well as making sure that financially this is a fit for you. As I mentioned a little bit before the presentation began, the role of platforms, including Equivesto, and the reason that we are licensed as an exempt market dealer, is to help protect both the businesses and the investors themselves. And we protect investors. One way that we protect investors is to make sure that you understand the risks and potential rewards of investing in this, and we're able to give you some real financial advice that's custom and suited for you around these type of investments, and whether or not they're a fit for your goals. You go on Instagram and Facebook right now, there's a lot of flashy, exciting marketing that's convincing you to do all sorts of stuff. It would be easy for someone without rules like this in place to create a really flashy campaign to convince people to give them a lot of money and invest in their business, but they might not mention, some of the not as nice things related to their offering. And so what's important for the platform is to make sure that we can spend some time and work with every investor to make sure that you're given the tools and all the education that you need to make informed decisions about your investments. So we collect the information shown on screen: your name, contact info, your address, date of birth, your social insurance number, which is entirely optional. This helps speed up the amount of time it takes us to confirm your identity, but you do not need to provide it if you don't want to. We collect your employment status, your marital status, any corporate information. On Equivesto, we allow individuals to invest as a corporation via their business, but many investors just invest personally, and so then you wouldn't need any corporate information. And then also we collect some personal financial details like your income and net worth, and we collect information about your risk profile. We also collect some additional documents depending on the account type that you apply under, but I'll talk about that a bit later. So as I mentioned, we collect this information because it's required by law. When you're signing up, we are doing an identity and a background check and a criminal check to make sure that you're not using our platform for money laundering or anything like that. And opening an account with us is similar to opening a bank account. We're a financial services company, and we have to ask all sorts of questions to make sure we understand who you are and all the details about your life. Also, as I mentioned, our role is to make sure that you understand the risks of investing in equity crowdfunding, and we can help you determine if investing in equity crowdfunding investments is the right fit for you and your goals. Even though the minimum investment is only $100, so it's designed in a way for everyone to be able to participate, it's still important for us and required by law for us to make sure that we understand, your goals and your objectives to make sure that this is a fit. So let's talk about an example scenario. So this is a pretend person named Jimmy. He's 19 years old. He's married with one kid, And sadly, he's unemployed as a result of COVID. So his family has limited income right now, and he has some student debt. And so as a result of that, he has a negative net worth. And so he signs up deciding that he wants to invest, a bunch of money on Equivesto. As part of him signing up, we would talk to him, understand a bit more about his situation, get this information, and we would reach out to Jimmy directly and say, based on the information you've provided, given the investments are high risk and you won't be able to take your money out for at least 5 to 7 years, and the fact that you could lose your entire investment, we would actually advise him not to participate and not to invest via our platform at this time. If you only have a limited amount of money, given your scenario, and he's married with a kid that he has to take care of, we would highly recommend keeping that money and saving that for a sort of emergency fund or a rainy day, or using that to pay down some of his debt. So we would want to talk to him and make sure that he understands all the risks that were involved with investing, and sort of clarify that based on his scenario, it doesn't seem like equity crowdfunding would really be a fit for him at this time. Generally, just as a sort of rule of thumb, we generally do not recommend putting more than 30% of your total investment portfolio towards ultra high risk investments or anything like that. We want to make sure that people understand the risks, and they're not sold by the sort of sexiness of investing in startups and put in more money than they really meant to. And so we're really here to protect the investors and make sure that you understand everything before you're making your investment decision. So let's talk a little bit more about the different account types. So you've gone through, you've created your account, and now you've submitted your documents through to Equivesto. As part of that process, based on your responses to some of the questions, the system will automatically let you know what different type of accounts you are eligible for. So there are 4 different account types offered on the Equivesto platform. The first is the retail investor. So this is the account type open for everyone. No additional documentation is required, and it's the easiest and most straightforward to apply to. However, because it's the easiest and most straightforward and it's for everyone, the government has actually set limits on the maximum amount that you can invest in startups and high risk investments. And that is $2,500 per campaign and $10,000 per year. And that's set by the government in the rules. And that's not anything that we at Equivesto can change. But if you feel like that's too low, let us know and we can, talk to the government about it. But it's a government set limit. The next type of account, so the one with the sort of next highest limits, is the eligible investor account type. So with this one, you have a bit more income, a bit more net worth, but you do need to provide some documents to support and sort of prove that you fit in this account type. So you need to provide, your last year's tax return, or a bank statement or statement from your accountant documenting your net worth. But this type of account gets you larger investment limits, so $5,000 per campaign and $10,000 per year. The next step up, just like what we were talking about at the beginning, is the accredited investor account type. So you've got the 200,000 or more in income, the $1 million in net worth, excluding your house. Again, you do have to prove that with the documents. So the tax return from last year or statement from your bank or accountant, but you have much higher limits. 25,000 per campaign, 50,000 per year. You also have access to accredited investor only deals with which you would have no investment limits. So you could invest much higher amounts. And then finally, the last account type is the permitted client. So permitted client is the highest net worth individual that we have on the platform. Again, you need supporting documents for that. But if you have over $5 million in net worth, which could include your house in this scenario, you have no limits of any kind, and you can invest in anything you like. So in the process, you've signed up, you've given your information, and you've completed your forms. As part of that, your account has been chosen. We've reviewed all your documentation and approved it. The next step is to review the different companies. We have a whole range of companies on the platform that people can invest in. Also, this sort of sign up process is relatively similar at other equity crowdfunding platforms. Of course, they don't all operate in the same way as Equivesto, but they all have to follow similar requirements because we all are bound by the same rules, and most of us are all registered as exempt market dealers. So you'd still have to sign up, fill out the forms, provide the documentation that's necessary, get approved, and then you can begin investing. Once you review the different deals that are available for offer, you can quickly go through, and just a few clicks later, you can invest directly in those businesses. So this is actually what it looks like to get started. You would look at you'd be on the investors page of our website. You'd click sign up, and it would take you to this easy sign up screen here, where you just put in your name, email, and password to begin creating your account. Then we would go through and review it. So we can take up to 1 business day to review and approve your account. And if we need anything else, we may reach out and ask you additional questions about your scenario. Or if we have trouble confirming your identity, we might ask for just a copy of your photo ID, which includes your address to confirm that. Once that's finished, you'll get an email from us with your investment limits. Next, you can actually browse the offerings. So this is a selection of some of the companies that are currently live on Equivesto, but we have several more as well that are live and launching soon. So when you review the offerings page, you can see some details of the campaign, who is eligible to participate, the amount of equity or investment that they're accepting, and how much or little you can invest, and how many days are left in the campaign. Once you pick an investment that you like, you should take some time to review the full details of the campaign page. So the campaign page is going to contain all sorts of information about the company, as well as several documents, which might include financial statements, financial projections, shareholders agreement, and an offering document. We highly, highly recommend taking time to review these documents so you can understand the full details of the company and what you're choosing to invest in. Once you're ready to invest, you can click the ready to invest button, and that'll take you to the investment process. You arrive on a screen where it says to choose the investment amount. You can, with a slider or by typing in the number of shares, can easily choose the amount that you want to invest. Then the next screen takes you to some documents that you need to sign, and the little red flags take you to exactly where you need to go to sign that. It's all done digitally. Once that's finished, it takes you to the final screen where you provide your bank account information to pay for your investments. So we only accept payment for investments through what's called electronic fund transfer. So it's sort of like a more old school version of an email transfer, but it's a digital way to move funds. Essentially, by putting your information in here, you're authorizing our system to remove exactly the amount that you've chosen on the previous screen, and that gets directly removed from the bank account of your choice and placed in our segregated account where it's held for the duration of the campaign. Once the funds are moved, once you've put that information in, it completes the transaction. It can take up to 5 business days to move the funds from your account. So please make sure that you have enough funds in your account for the entire 5 days. Otherwise, you may be charged with a $15 not sufficient funds fee. And you'll get email updates throughout this process on the status of your transaction. We also have a few things in place to help protect investors, because with equity crowdfunding, we're essentially allowing everyone to invest in startups for the first time. We want to put a few additional protections in place so that we can really take care of investors and make sure that nothing is happening that is planned. So in addition, to making sure we're moving funds in the most secure method possible, There's also a 48-hour backout window. So you've gone through this whole process, you've clicked invest, but then you've realized, oh, you know what? I changed my mind. I got too excited, but I shouldn't have invested. If you let us know within that 48-hour window, we will fully refund the money. We'll still need to move the money out of your account within that 5 days. We can't turn off that request for the funds once it's been activated, but we will fully refund the amount that you chose to invest with no fees related to that at all. Also, as I mentioned, for the duration of the campaign, the funds are held in Equivesto's segregated account, so they're not, given to the company right away. They're held there for the duration of the campaign. If the campaign doesn't reach its minimum funding goal, all of investors' funds are fully refunded to the investors. So even if the campaign's just getting started and it's only got, $500 of its goal, you don't need to be worried. You can still invest, and the money will only go to the company if they do reach their goal. Also, and very important to mention, when you do make your investment and provide your bank account information on that last screen, we do not actually record or collect that information. That is a sort of floating screen that's connected to our payment service provider who moves the funds in that secure manner. So we don't collect that information as Equivesto, and that's not stored anywhere where it can be accessed. It's kept entirely secure for you, and that's why you provide it every time you invest. Thank you very much, and I'm excited to answer any and all of your questions.
Yeah, what happens if I'm fairly wealthy and 35, but happen to be unemployed right now?
You're unemployed currently, so your income would be zero for this. It would also depend on your net worth as well. So if you have, let's say you have 200,000 in net worth or something like that, or 400,000. Um, if you had enough net worth to be an eligible investor, you could still apply as an eligible investor. We would have a discussion about your current employment scenario, whether you have funds set aside to cover your living expenses and everything right now, whether you're planning on returning to work. Some individuals are um, sort of they choose to be unemployed because they have enough wealth to live off of, and they generate enough return from their existing investments. So in that situation, just the fact that you're not currently employed is not going to restrict you from participating. But it's really about taking the time to have a direct conversation with you, or this pretend person, you, so that we can feel comfortable that you know what you're doing and you are comfortable with your investment decisions, and you realize that these investments are longer term, higher risk investments.
So, on that vein, what kind of reporting goes to investors? And, other than the annual general meeting, if, you as an investor, you invest in your platform, what kind of information do you get updated with?
Yeah, that's a really great question. So the required information to be provided from a company to its investors is actually dependent on the type of raise the company does. There's many different ways companies can raise capital from investors, and the government has tons of different rules based on which way they choose to raise. So if the company is choosing to go through one doorway, they'll have to provide audited financial statements. But if they go through another doorway, they'll only need to provide statements prepared by an accountant. But if they go through the most popular doorway, there's no legal requirements to provide statements. So because of that variability, there's no sort of quick and dry rule that's saying every company is going to provide the same level of reporting, even on the companies listed on Equivesto. The best place for investors to confirm exactly what reporting they're going to get is in the offering document, which is attached to the campaign page. The offering document is the most important document associated with a crowdfunding campaign, and that essentially outlines basically every question and every piece of information that an investor would need to know about the investment. It tells you exactly the details of the type of shares you're getting, the price you're paying, who else is already invested in the company, all the information about the founders. It's talking about the plans of the business, the risks of the business, any reporting that you're going to get. All of that information is in that document, and that is legally binding.
I'm pretty sure there's some OSC rules around this, you can probably answer that. But there was a question here about somebody who was looking on your website and they were hoping to find where they could just invest in a pool of companies on Equivesto's site.
Ah, that's a great question. Currently, it is not possible to invest in a pool of companies um, because the minimum investment is $100. That allows you to essentially make your own pool if you invested $100 in each of the companies on the platform. Our goal in the future is to create a pool where you could simply invest in that, and then the pool would invest in every successful deal on the Equivesto platform. But just so you know, setting up a pool in that way is actually setting up an investment fund. And there are specific rules and restrictions around setting up an investment fund that makes itself available to the general public. You need to provide audited financial statements on an annual basis, and the individuals who lead and control the fund have to have specific certifications, and the whole fund has to be registered with the government and meet all kinds of requirements. So it's not as simple as saying, I've just got a separate account here and you just put your money in there and I'll just put it in every single company on the platform. It is something we want to add, but it does take considerable time and effort to actually set up and register an investment fund.
So I got another question here. If do I need to create two accounts, one as an investor and one for raising capital, or can I just create one account and use it for both purposes if you need it?
That's a great question. We would ask that you create two separate accounts because when you're creating an account, the information we collect on the sign up forms are very different, but each account is tied to an email. So you would need actually two separate email addresses. If you were looking to raise capital, we would recommend using your company email address. And if you're looking to invest, we would ask you to use your personal email address. But yes, we would ask that you have two accounts.
And that makes sense. So I've got another question here. What happens if Equivesto runs into difficulties? You seem to be the investor's only link to the company.
So that's a great question. We are the link to the company while the transaction is taking place. However, once the transaction has taken place and you've invested, we're actually no longer involved in that relationship. So once we sort of broker this deal, the company is given all of the investor information, and it's their responsibility to sort of reach out to you and provide you with direct updates on the documentation of the investment, including the offering document. You're actually provided with all the contact information of the company itself, their address, phone number, the names, emails, everything like that. So after the campaign is finished, it's the company's responsibility to take over that relationship and to provide those updates.
So you mentioned the offering document,
Yeah.
and how long are they? And are there specific sections I should be focused on, or do I really pour through every aspect of it?
So the offering document is actually a templated document provided by the government. So the government has a template, and it literally says, section one, fill out this. Section two, fill out this. And so the variability in length really comes down to how much the company writes in two sections. One, which is their sort of business operations section, where they talk about what the company does, their goals, their competitors, all that sort of stuff. And two, the risk section. So that's where they can talk about the risks to the business, the risk to the investment, all that. Other than those two sections, the length is pretty fixed. The shortest I've ever seen one is usually between 9 and 10 pages. When they provide a lot of information about the risks in the business, it can grow to maybe 30 pages. But there is a lot of really good information in the document. I'm not going to recommend that you don't read it. I'm going to recommend that you do read it, and I'm going to highly recommend that you read all of it. Part of actually one little checkbox that you have to fill out when investing is that you acknowledge that the offering document has been provided to you and you've had an opportunity to review it, and are only investing on the basis that you've reviewed that offering document. So I'm not going to say only look at section 3. When you're looking at it, I think you want to make sure you understand the risks involved. You want to understand the reporting, which is a question that we already talked about, Craig. Make sure you understand that. You want to understand the securities that you are buying, exactly the share and the share class, and what rights you have. So there's a whole section talking about the rights that you have as a shareholder. I would definitely make sure to fully understand that. Um, and again, I would read the whole document.
Do we have time to talk about the different share classes that you offer?
Yes, we can. So companies are the ones who choose the share classes. So if you go on the stock exchange, you can even buy different share classes on the stock exchange. On Equivesto, again, there is that variability. So companies can choose to offer different types of share classes depending on their goals. So there's generally two share classes that are going to be offered on Equivesto, either common shares or preferred shares. Preferred shares uh, are usually they don't have any control or voting rights, but they're called preferred shares because they're usually given preference with in terms of payouts. So if you see something as a preferred share, usually there's going to be a guaranteed payment from the company. So they would say, we promise to pay this investor, X percent um, per year for the next X number of years. So that's sort of a preferred share. A common share doesn't have access to that sort of preferential payment. And that's sort of the base share. So that's usually the type of share that the other founders or most investors are getting. When you think about other angel investors or venture capitalists, when they're investing and they're investing for the long haul, they're usually getting common shares. So it's most likely that investing on Equivesto, you'll be getting common shares. Common shares share in the benefit of any dividends. So if the company decides to pay out dividends to all of its investors, you would get some of that. Also, if the company gets sold, you would benefit in the purchase of those shares as part of the sale of the company. And common shares can further be divided into voting common shares or non-voting common shares. Obviously, as the name implies, voting common shares are those who can vote and control the business via shareholders meetings. So they would vote to pick the board of directors who would then go and lead the business. Non-voting common shares do not have a vote. Given the size of the investments through equity crowdfunding, most people are putting in a few hundred or maybe $1,000 or $2,000 with equity crowdfunding. Even if you invested the maximum retail investment, the $2,500 per campaign, given the number of shares and the size of the companies, even though they are quite new, um, even if you were given voting shares for your $2,500, you would have essentially no control over the business. Your vote would be so small, it would be 0.01% of the business would be the amount of your vote. And so we specifically make sure that all companies raising on Equivesto have clauses in the shareholders agreement to protect minority shareholders, whether they do have a vote or do not, because even those with a vote essentially have still no control over the business. So we want to make sure that there are rules in place, which we call tag along and drag along rights, which protect shareholders from essentially being screwed around by the larger shareholders of the business, which is usually the founders. So tag along and drag along rights essentially mean that it doesn't allow the majority shareholder to sell their shares, but not sell everyone else's without you being included. So let's pretend a company shows up and they want to buy the startup. Without these clauses in place, technically that company could just go to the majority shareholder, 51% of the shares, and say, hey, we'll buy 51% of the shares and leave the other 49%, because then they'll still get control of the business. So that would, of course, enable maybe the founder and a couple initial investors to get their money out, but then everyone else, the 49%, would get stuck in the business and wouldn't have any opportunity to make a return on their investment. So the tag along and the drag along rights prevent this from happening. They ensure that if someone is being offered over 50% of the shares, they have to divide that evenly. So instead of, for example, oh, I'm going to buy 51% of the company and I'm going to buy all of the 51% of the shares from the largest shareholders, you would have to divide that 51% equally between all the shareholders in existence. So I'm going to buy 51% of your shares and 51% of your shares and on and on and on. So it ensures that every investor gets treated fairly and has a potential exit. So that's the most important thing that we do to make sure that all shareholders are protected. And we do that no matter what type of share or company is coming on the platform. So if they're raising on Equivesto, they must have these tag along, drag along rights.
So I really appreciate you taking the time today. If people want to find out more about you and Equivesto, where do they go?
They can go to equivesto.com. If you want to learn more about actually becoming an investor, you can go to equivesto.com/investors, or to just learn more about everything Equivesto related, you can head to equivesto.com/learn. You can also follow us on all social medias at Equivesto.
And thanks everyone for attending. Hopefully you learned a lot today. I did, and we'll see you all again soon. Thanks everyone.
Thank you.